I want to bring in Marc Pado, U.S. Market Strategist at Cantor Fitzgerald. And Marc, let me ask you how much of this, I mean, we're seeing financials drop today. There's been a lot of news, obviously, recently about the TARP money being paid back, but dominating the headlines today, news that Washington is going to move forward with plans to regulate executive pay, especially at companies that have taken government assistance. Is that going to weigh on, is this kind of regulation and these kind of government interventions, are those going to weigh on equities going forward?
Well, it's weighing on economic growth overall in that the banks are choosing to pay back TARP to avoid these restrictions rather than lend the money, stimulate the economy, and do what TARP was intended to do. So with Congress stepping up the pressure on executives, who, by the way, have to be the ones making the decision, they're actually taking away the effectiveness of TARP. So it's unfortunate, but I think that that's part of the reason why the market is slipping and the financials are slipping today.
We do need, you say, financials to hold stable for this rally to hold. We haven't done so poorly, though, in the last couple of months, up almost 40% since the March lows. Don't you think we've already moved quite a bit?
Oh, yes, but I think that March low was a little bit false in that, if you remember the discussion at the time, actually the day before the market hit the low was when they were saying that the Democrats were trying to nationalize the financial system and that all the banks were going to fail. If you remember, the rumors were Citigroup and Bank of America were about to go under, and that created the low. As we know, the Federal Reserve had already insisted that they would not be nationalizing the banks, and the banks rocketed back. So the first 50%, 100% move in the financials was just unwinding the false rumors.
How do you think, or where do you think we need to go from here? You say there's a lot of money on the sidelines. We've been hearing about that from a lot of people. Is it going to come in this year? How much do you think is there to actually come in, and how much is on the sidelines to stay?
Well, I think that if we get back to about the $3 trillion mark, that would actually be a conservative estimate. We're at $3.76 trillion, so about $760 billion more through the end of this year. I don't think we'll get there before the end of the year because most investors will want to see the economy start to do better, and we don't expect that until the fourth quarter.
Where does that put us by the end of the year, you think, if we see another 760 come in from money markets to the market, equity markets?
With the S&P, I think, certainly above 1,100, 1,150. 1,200 would be optimistic. Maybe by the first quarter, that would be really the end of this more massive run. For the Dow, we'll be back above 10,000, maybe not quite 12,000, but 11,000 would be a nice round target. So I do think that we have good upside potential going into the end of the year. I do expect to see after this particular run that we'll get a little bit of a setback and the consolidation in the third quarter.
But only a little, I'm guessing, right? 5-10%? What do you think?
Yes, absolutely. A pullback versus a correction, and certainly not a test. Like I said, I think the March low was false. You mentioned steel stocks in your earlier segment. If you look at steel, technology, retail, and several other groups, they never made a new low when we came down in March. They actually held above their November lows. So what we have are what they call W bottoms across the board in most indices, and we're just now breaking out of that intervening high. So there's good upside potential, 15% for most groups.
Where are the strongest headwinds, though? And, when you bring up retail, I automatically think about unemployment. We're looking at about 10% by the end of this year. Those are our new estimates from our most recent survey. Doesn't that hurt prospects for retailers?
It does, but you have to look at where we were in terms of the expectations and the comparisons. Come the fourth quarter, now this is not a third quarter story. The third quarter story is all about inventory rebuilding. The fourth quarter story is going to be about sales. The year-over-year comparisons are going to be quite easy. If you remember, the fourth quarter was horrible last year. So we're going to have easy comparisons. You're going to have good upside potential, and probably most important, and this isn't good for jobs, but right now they've reduced everything so much that any incremental sales is actually going to go right to the bottom line. So we're talking about an increase in profit margins in the fourth quarter that will really kind of get the stocks moving. So when we talk about the stocks, not about the economy, not about jobs, but about the stocks, I think they still have much more to go on the upside.
And they're discounting the economy, you still expect, by about 6 months.
Yes, they are discounting. I think they're still a little bit negative. Like I said, the inventory rebuild alone could add as much as 2% between the third and the fourth quarter to GDP. So that's a big number.
Gotcha. All right. Hey, Marc, thanks for joining us. Marc Pado there, U.S. market strategist at Cantor Fitzgerald, coming out of Reno.